Hi, this is Greg Kilpack of MarketTimingUniversity.com, and I got an email from Edgar's from Latvia. I found this stock, which is PBR, and he asks, is it a long or short-term investment or a rooting corpse and should not be bought at all? He says that English is not his native language and would like some more information about that. I would love to hear your opinion. All right, well, Edgar's would be happy to help you there. Let's take a look at PBR. First off, what is PBR? Let's go to the profile section. Right there. Okay, PBR, PetroBrazil, an integrated oil and gas company in Brazil and internationally. It's in crude oil, natural gas, and some other oil and gas related products. It's been around since 1953, so quite a while. And it's got 85,000 employees. Obviously, very big company. Okay, well, that gives us a basic profile about this company. Now let's take a look at the stock chart. The first thing I want to look on any stock is the big picture on the stock chart. So I want to look at a 5-year chart that'll give us an investment snapshot on what's been going on. Now, already I'm seeing some things that concern me. PBR has been going down, as you can see, steadily for the past 4 years. It topped out at above $50 a share back in late 2009, and it's been steadily dropping since then. Not a good trend. Okay, your $100,000 investment on this stock right now would be worth $30,000. So quite a big hit on this stock. Yeah, not good. We want to see something that's steadily trending up, really, without too much volatility, and obviously we're not seeing that here. So this is, if anything, a turnaround play. What we want to see in a turnaround play is that a company has been falling for some reason, and whatever that reason is, management has turned it around and it's going to start to go back up again. The results or the evidence of that should come in better profits, or evidence of that better profits will come based on some actions that they're taking. Okay, so first off, let's look at the income statement and see if they are getting better profits. Let's look at the profit picture. Okay, we've got 3 years of data here, and this is the column for the entire year of 2010, and for 2011 here, and for 2012 in this column. Okay, so in 2010, the revenue was $120 billion. All these numbers are in thousands, so you add actually 3 more zeros to this. So that's $120 billion. In 2011, the next year, it went up to $145 billion, an increase of $25 billion. That's a good sign there. And then to 2012, it actually dropped a little bit right there. So that wasn't so good. Let's go down and look at the profit picture. 2010, they did $20 billion. In 2011, they actually dropped. Now, wait a second. They had a $25 billion increase in revenue, and yet they had lower profits. So that's not right. Something's wrong there. That is not good. Trying to figure out what it might be from some of these other numbers, but I'm not seeing it just on a moment's glance here. So let's go to the next year. Same revenue more or less in 2012, and we actually have a 50% loss in revenue, or excuse me, in profits or earnings. So that's bad. I'm not liking this trend. The income and revenue and profit trend is not the way it's looking at it should. What we want to see is a steady increase in profits and revenues from year to year, and we're clearly not seeing that. So that's trouble. Now, obviously, a big oil and gas company is going to be heavily influenced by the price of oil. And, eventually oil prices will very likely go up. But, there's nothing for sure in life, right? So, not really thrilled about what I'm seeing so far. I see the stock price going down, and I see an unstable revenue picture. Let's look at one other thing, and that's the key statistics. This will help you understand how much risk you're taking if you do buy this stock. Okay, and you see that in the PE ratio. Basically, a trailing PE ratio is the trailing 12 months to tell you what the average intraday cost of this stock is, basically. And it's 8.45 times the earnings is the price of the stock. The projected is about the same. It's just over 8 price compared to earnings. That's a pretty good number if, and this is a huge if the stock is going to improve, if the revenue and profits picture is going to improve. So right here, so far, this is the only thing that looks appealing to me at all about this stock, because we don't know if the stock price is done going down. We don't know if the revenues are going to remain flat and the profits are going to continue to go down like they have the last couple of years. But here's the good thing about this, based on these numbers. If you do buy this stock, you're paying a fairly inexpensive price for this. But really, this is not my favorite stock to buy. This is not the kind of picture I want to see in a stock. We got to have some evidence that this stock, in fact, is turning around before I want to buy it. Do we see any evidence of that? Well, I don't yet. And I'm not going to rely on, hopefully, higher oil prices at some point just to buy this stock. So basically, I don't want to buy this stock. I'll have to say no on this. In spite of the fact that, let me show you one other thing on the chart. Excuse me. Let me go back just a little bit and show you something. Now, the stock price was down here. It went way up, came way down, and it's bounced around. And now we're near lows. Does that mean it might be worth taking a little risk on it? Well, maybe, but it's still not my favorite stock to buy, so I'd have to say no. I do want to watch a stock like this for evidence that it is turning around, because if it does, then it would be a great buy. If it starts to do better in revenue and earnings, you can expect to buy it between $15 and $20 a share, and then hopefully it'll go back up to 50 and you'd make more than double your money. Maybe 60, maybe 70 like it did a few years ago. So you could still make 2 to 3 times your money on a stock like this, but it's not a very sure thing at all, and not the kind of stock I want to buy. You can make 2 to 3 times your money in other more sure trades than this. So basically, I'll have to give it a thumbs down on this. Okay, and these are the reasons why. Now, like I said, I would keep it on my watch list, but not something I want to buy at this point. Now, please go to my website at markettiminguniversity.com. We teach how to triple your money once per decade. Okay, at least that much. There are ways to do it. There are easy, safe strategies that I teach how to do it. Now, I don't actually sell anything at this point, but I will soon be teaching courses next year, 2014, about how to do this, how to predict when the market is going to go up or down, and how to triple your money at least once per decade. If you click here, you can get my free report, 3 things every investor must know to earn greater profits, take less risk, and invest with confidence. Also, if you go to my YouTube page, you can watch my free videos and learn a lot there. Also, you can go back and read my blog right here. So until I actually sell the information that I'm going to be selling in the courses next year, go ahead and get what you can for free. This is Greg Kilpack, and hope you will subscribe to me on YouTube so that you don't miss any more episodes. Look forward to seeing you there. Hope this helped. Have a great day.